Hi everyone, Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market, and thanks to the more than 10,000 of you that have subscribed. And if you haven't, just click on that subscribe button so that you never miss a State of the Market video. All right, today we're talking about growth stocks versus value stocks, and growth stocks have outperformed value stocks for about a decade now. And we're talking about stocks like Facebook and Amazon and lots of smaller players. So they've been outperforming until recently. Over the past year, value stocks have actually been the better way to go. Go back a little further, and growth stocks were the better bet. Go back even further than that, and value stocks outperformed. Now, if you're unfamiliar with the term growth stocks and value stocks, growth stocks are companies that are rapidly growing their earnings and their revenue, and their valuations typically are higher. Value stocks, on the other hand, tend to be more mature companies. Their growth tends to be slower, and their valuations are lower. They're very inexpensive usually. There's been a decades-long battle between believers in growth stocks and value stocks and which methodology is better. And the truth is, there tends to be a rotation between value stocks and growth stocks, and the outperformance in one or the other usually lasts over multi-year periods. Okay, with value stocks outperforming lately, I decided to take a look at some value stocks to see if we could come up with 3 attractive picks today. And to do that, I screened for stocks that had PE ratios of 15 or lower. And the reason I chose 15 is because the historic average over the past 150 years of the S&P 500 is a 16 PE ratio. I also screened for stocks that had a price to free cash flow ratio below 10. And I did that for 2 reasons. The first is that is considered an inexpensive stock at below 10. The other, perhaps more important reason is that I want to make sure that a company is actually generating free cash flow. I don't want to pick a company that's bleeding cash, but that has positive earnings through some accounting magic.
Welcome to my world of magic, where the incredible is credible, the unimaginable is imaginable, and of course, the impossible is not only possible, it's probable.
Additionally, I only included companies that are growing their earnings. I want companies that are moving forward, not backward. All right, so for this video, I chose a large cap, a mid cap, and a small cap. So let's get started with our large cap stock first, and that is Ford Motor Company, ticker symbol F. Now, Ford has a bargain 7.6 PE ratio. Last year, the company earned 40 cents per share, but it had a big first quarter 2021. So trailing 12 months earnings per share is $1.80. And in the past 4 quarters, it generated $23.9 billion in free cash flow, which means the stock is trading at an insanely low 2.4 times free cash flow. Again, anything below 10 is considered cheap. Now, its pickup truck, the F-150, is the best-selling vehicle in the United States for each of the last 40 years. Now, they're coming out with an electric version of the F-150, and I expect that to be an absolute home run. So Ford is very attractive at these levels. All right, moving on to our mid-cap pick. That is media company Tegna, ticker symbol TGNA. Now, Tegna owns 62 TV stations and 4 radio stations in 51 markets. That includes KSDK in St. Louis, KARE in Minneapolis, and 2 TV stations in Atlanta, WATL and WXIA. Now, the stock trades at just 7.8 times earnings. Earnings per share is forecast to grow 40% next year. And over the past 4 quarters, it generated $640.5 million in free cash flow, giving the stock a price to free cash flow of just 6.3. And it has a 2% yield. And those of you who've been watching my videos for a while know that I'm the dividend guy and I love stocks that pay dividends. Now, Tegna should benefit from massive media buying from the 2 political parties as we head into midterm elections next year. And oh boy, I cannot wait to see what kind of beacons of truth they produce. All right, for our last stock, our small cap, as Steve Martin might say,
let's get small.
Which incidentally is the greatest comedy album of all time, in my opinion. But our small cap stock is USA Truck, ticker symbol USAK. And this is a very small cap, just a $135 million market cap. has a PE ratio of 12.2, and revenue is forecast to grow 20% this year, and earnings per share is projected to explode 248% to $2.20 per share. And based on that figure, it's trading at just 7 times forward earnings. In the past 4 quarters, USA Truck generated $38.6 million in free cash flow, so the stock has an ultra cheap price to free cash flow ratio of just 3.5. And as the economy continues to be strong, the need for trucking will only accelerate. So you've got Ford, Tegna, and USA Truck, 3 stocks to get you started looking at value stocks today. All right, thanks very much for watching. And for more wealth and income building ideas, be sure to check out my free e-letter, Wealthy Retirement. Click that link below. It's absolutely free, no credit card required. And I'll see you next week on State of the Market.